Good evening, all the members. Welcome you all for the today's seminar on regulations and Schedule 3 of Companies Act and CARO regulations. This is the first meeting on Companies Act. The eminent speaker from Balganation from Hyderabad is a cool one, and actually we planned for a 6 days program actually for last month, but it did not happen. Now it's a pleasure to sir to be here with the Guntur branch. Thank you, sir. I welcome all the members for the August evening. Now I request Chinta Raghunandan to introduce the today's chief guest, Galpat Satyanarayana Garu, to the August gathering. Over to Raghunandan, please.
Good evening, members. Today's chief guest of our today's session, Galpat Satyanarayana Garu.
Please.
1 minute, sir.
Can I introduce?
CAG Galpat Satyanarayana, Chartered Accountant, hails from remote village Pipparla, Nasrapet Taluk, Guntur. He is second son of Sri Galapati Surya Prakash Rao and Srimati Galapati Punnamma. He belongs to a reputed agricultural family and well-known family of this area. He completed his primary education from his village and secondary from Sangadudipadu, college education from at Nasrapet, and Guntur. He had undergone his articles at Mrs. K. Gnanandulu and Co. Chennai and completed his CA in the year 1982. He has been practicing under the name of Mrs. Galapati and Co. from 1983 at Guntur. He had married to G. Indra Devi Garu, MA, in the year 1984 and blessed with one daughter, Srimati Makkam Lakshmi Hima, who has completed her CA during the year 2020. His son-in-law, Makkam Anrup Krishna, is also a CA and All India 9th rank holder in the CMA course. CA Galapati Garu worked as chairman for Guntur branch and also as vice chairman secretary. A building was acquired at Srinivasarao Tota 11th line during his tenure as a managing committee member. He is a co-opted member. He's for Fiscal Law Committee of Southern India Regional Council of ICAI for the year 2003-04. He worked as a tax bar association for the president and he conducted various seminars on various topics for enriching the knowledge of the members. He is currently working as secretary for Indian Chamber of Commerce Guntur. He worked as chairman for Taxation Committee, Indian Chamber of Commerce Guntur, and co-opted member for Fiscal Law Committee, FSCCI, New Delhi. He is also associated with social organizations like Lions Clubs and Avopa. He was worked as a cabinet treasurer, Lions District 315, and worked as vice president, secretary for Avopa in the combined state of Andhra Pradesh. He also associated with Sri Venkateshwara Devasthanam Gorantla Guntur as a donor and life member. With this introduction, I welcome today's chief guest, Galapati Satyanarayana Garu, to the address gathering. Sir, over to you, sir.
Sir, unmute చేసుకోండి, sir. Unmute చేయండి, sir.
Thank you.
Yes.
Raghunandan, for your nice introduction to me. Respected Chairman of Guntur branch of ICAI Chartered of India, today's speaker Ganesh Balakrishna Garu. The Guntur branch was rightly chosen a topic which is important for us because the Schedule 3 amendments are applicable for the financial year 2021-22. It is far-reaching effect on our workings in finalizing the audit for the financial year 21-22 due to many amendments made in Schedule 3 disclosures. It makes a stringent amendments made for disclosure. It is very difficult to the companies to hide their financial strengths and weaknesses. Some of the amendments they made is far-reaching. It requires more time and we require to attend more concentration, and it requires more analysis for conducting the audit for the financial year 21-22. See, the main aim of this amendment is to improve the transparency in the finance statement. MCA is increasing stringency in compliances and adding numerous additions, disclosures in financial statements and audit reports. In recent years, there have been substantial change in the reporting requirements by the auditors, but no such amendments made in the Schedule C3 for the preparation of the finance statement. Thus, to align with the company's finance statement in accordance with the auditor's report requirement, amendment made in the Schedule 3. CARO was also introduced. CARO 2020 was introduced, which was deferred for the introduced during the financial year 19-20, but it was deferred to 21-22 due to COVID 2009 pandemic situation. See, some of the amendments we see regarding the current ratio analysis, which we use to apply for the applying the cash credit limits or term loan limits, but which we have to consider and compare with the previous year. It means it shows the financial strength and weaknesses of all the companies. And also, I find that we have to compare the current assets and current liabilities with previous statements, which are required to submit to the bankers for the limits enjoying more than 5 crores. Nowadays, the bankers are taking very lenient view. They are just taking the papers and keeping their files. Nobody is bothering about what they are filing, and they are not at all comparing with the current finance situation. But after this amendment, we have to compare the books quarter wise instead of financial year wise. Quarter wise, that current assets and current liabilities, and we have to disclose the reasons for the departure from the statements submitted to the bankers and to the as per books of accounts. And also we are required to file the aging analysis, which previously we filed only for more than 6 months to below 6 months. Now we have to analysis for number of days as bankers asking for our stock price. These are the far-reaching amendments for us, and I request the Ganesh Balakrishnan, who is an eminent speaker in this company law. He submitted many papers on company law. I request throw light how to easily we do the audit and advisors to our members. I think this is the right time for the Guntur branch to choose this topic and choose a speaker, and I request the members to concentrate on it and do the needful. And I thank you for the management committee of Guntur branches for giving the opportunity for giving the opening remarks. Thank you, sir. Thank you, sir.
Thank you very much, sir. Galpattu Satyanarayana garu, past chairman of the Guntur branch of SIRC. Now I introduce today's eminent speaker, Ganesh Balakrishnan from Hyderabad. Ganesh is a partner of audit and assurance practice with 3 decades of experience, and he is the office managing partner of the Deloitte Haskins and Sells LLP from Hyderabad office. Ganesh heads the learning and development for the South Asia cluster for Deloitte and audit function. Ganesh is a part of the IFRS faculty with the Institute of Chartered Accountants of India for all their in-house and open house programs, and serves as the faculty of the Dun and Bradstreet for their programs on IFRS and US GAAP. He is the co-opted member of the research committee of the Institute of Chartered Accountants of India for the year 2015-16. He was a co-opted member of the research committee of the Institute of Southern Region of 2009-10 year, and was the co-opted member of the Auditing and Assurance Standards Board for the year 2010-11. He has been involved in the preparation of the implementation guide on materiality, sampling, and going concern released by Accounting Audit and Assurance Standards Board AASB. He is associated with the Quality Review Board and Peer Review Board set up the ICAI, the Institute of Indian Accounting Regulatory, on the technical reviews of the accounting firms. He is on the regular faculty of the Board of Studies of the ICAI in imparting web-based lectures for students. He is presently associated with the Dr. B.R. Ambedkar College and Bhavan Vivekananda College for a review of syllabus in accounts and corporates. He has undertaken IFRS training for the Osmania University faculties. He has presented papers in various forums in India and internationally at universities and other professional bodies of IGAAP, USGAAP, and IFRS. He graduated from Osmania University and he is a fellow member of the Institute of Chartered Accountants of India and a cost accountant. He is also a certified public accountant CPA from the American Institute of CPAs. With this brief introduction, I introduce today's eminent speaker, Ganesh Balakrishnan, to the August gathering. Thank you, sir. All the best.
Thank you very much, Srinivas Garu, and thank you so much, Satyan Garu. I think you set the perspective, set the context too for today's topic. And my apologies, Srinivas Garu, because I was held up in because of some COVID-related situations with some of my office colleagues. So I couldn't conduct your session, which I had agreed on Companies Night. So probably someday we will do that for you.
Thank you.
So that's something, it's my promise to you. But definitely a very good evening to everyone. I would expect more people. I thought there were more people from the administrative side of Guntur branch, the office bearers, than the number of participants. But I think, what is very important for all of us is learning is a continuous process. And I think what is missing, and I think what people are not able to understand is that the government is going very fast in making sure that the CAs become jobless. That's also because, one of the points that Mr. Satyan talked about, the bank, when the stock statements used to be submitted, they used to be put in just in a piece of paper, never used to be bothered about it. Frankly speaking, if we don't rise to what the users expect from us, if we don't rise to what they believe that we deliver quality, this is the biggest challenge that we will be facing. It is in our hands whether you want the CA to be flourishing or CA to be just a part of the national education policy under the NEP as only a degree, which is so far C has been classified. Time has come for all of us to introspect, and I'll tell you why this is important. NEFRA has already issued a consultation paper, clearly shows that we are in no position, though we are raising voices. Let me give you a simple example. Income tax portal moved, income tax went to a new portal. But what happened? All the professionals raise you and cry. September of 15th is gone. They just extended it. We are happy about it. But really speaking, there was no noises from any of the industries. There was no noise from any of the forums, except the chartered accountants made some beautiful WhatsApp forwards which talked about Nirmala Sitaraman and all that. But what they are doing is what we are not able to envisage. They removed the mandatory audit under the GST. Now they've added, SEBI has added that anything related to certifying the paid up capital can be done by cost account. The finance minister went back to company secretary and said, please let us know which are the compliances which we can remove. So the question then, are we doing a compliance or are we doing an audit assurance service? Because we really do not know whether we are doing an audit or an assurance, compliance or an assurance. Honestly, all our standards goes on the basis of assurance standards, not on the basis of compliance standards. So this is the biggest challenge that we have, which we need to address it. The NEFRA talks about, and especially many of you who are in this call should be aware that if the mandatory audit goes away, see, as it is, after mandatory audit goes away, there is also a target to look at the bank audits, whether branch bank audits are necessary or not. Where are we right now? Now, so many changes that have been brought in. So many changes that have been brought in Schedule 3, so many changes have been brought in CARO. Though CARO got introduced in March 2020, it did not get implemented because it is not that because of a COVID it got deferred. It's only because majority of the information was supposed to be prepared by the company. If how is an auditor can comment on certain information which is not provided by the management, where the management does not take ownership of it. And that is the reason why the amendments to Schedule 3 was necessary. So if you see Schedule 3, a lot of changes have undergone place. And if you see all of that is nothing but whatever information that you may probably prepare for a management to take a decision, that's exactly what will be there. And this is something which I would want each of the professionals to understand, that if we are going to play the role of a management, we are into deep trouble. We should never play the role of a management. And this is something which I would want each one of you from the Guntur side, that it is important that you can advise a client, but please do not take responsibility of the client. And I think that's something which I will touch upon all of this. Take the case, one of the issues that have come up in the CARO is in respect of whether the company has got a whistle mechanism or a whistleblower mechanism, which in turn means that any issues relating to fraud should be reported to those who are in the board, who are independent of the directors, independent of the promoters, independent of the management. Now tell me, if you've got audits of proprietor companies where every decision is taken by that promoter, how are you going to evaluate this aspect of it? What are you going to write? So there are other questions which comes. We have been this, in fact, the chartered accountant's major source of revenue or a fixed source of revenue has been bank audits. Now, if you take an analysis of the NPAs as of 31st of March 2021, it is approximately around 8,34,000 crores, approximately that range. Now, if you see the overall India budget, right, which gets presented every February, it's about 34 lakh crores. In other words, we are saying 25% of that NPAs or the total money is not in the system when I compare that to the overall budget. That is the extent of where the exposures are there. And if you see, majority of the frauds that happens on the banks. And who tops it? If you take an analysis of the frauds which happened in a period, it's approximately 1,72,000 crores, which is again 25% of your NPAs. Now, of which 70,000 odd crores are only from SBI. And if you're an auditor of an SBI, and if you're not been able to identify that, how are we going to report on this? Leave all this. You are an auditor of the company which is declared as fraud. You're certifying all of these. How are you going to address this? I think time has come upon us. I think somewhere we as professionals have stopped learning. We have learned tax, we have learned GST, but we have stopped learning how to do an audit. What is expected from an audit? I think that is the whole idea as to why these changes are coming through. Now, if you just imagine 5 crores, and if you see the analysis of 5 crores, there are about 8 lakh companies, which is approximately, let's say there are about 8 lakh companies. Almost like 30% of them charges fees less than 20,000 or less, or some companies have charged even 0. So why do you need companies of that size? 25% is of no use. And that's the reason why the benchmark of having a paid up capital of 5 crores, you need not audit that. And if that goes away, so I mean, I've seen some companies within that where they had shown that the audit fee charged for the business is 0. How can an audit fee be 0? Or does it mean that there will be no disclosure of that audit fees? I think this is something which we need to seriously think about in respect of, especially when something like a consultation paper is coming through. And we are not taking it seriously. To be very honest, we have not taken it seriously. If we had taken it seriously, probably a lot of these issues could have been addressed. Just to correct, sorry, it is about 6 lakh companies, of which 0 fees is 1,81,000. 0 to 1,000 fees is about 817. Up to 5,000 is about 39,000. Up to 10,000 is 77,000. Up to 25,000 is 1,29,000. Can you just beat this? Greater than 50 lakhs is only about 200 companies. Greater than 25 lakhs is 4,800. So we are talking about 1,29,000 plus 1,88,000 plus another 1 lakh. We are almost talking about 4 lakh company audits will go away in no time. So that is the extent of what this profession is staring at. This profession is staring at something which is a fact where we have not charged audit fees. I think what we are really, I mean, when the Schedule 3 is coming through, why should we not raise an audit fees for the work that we perform? And this is a fundamental change shift that has to come through in all professions. And I think I'm going to touch upon some of these aspects of it. And these are all applicable to those accounting standards. These are applicable effective 1st of April 2021. That means already 6 months has passed by. And it's been classified between those companies that follow accounting standards, those companies that follow Ind AS standards, those companies which follows NBF, which are predominantly the NBFC companies. The whole objective of this, while we can say it is to bring transparency, enhance disclosure and all of this, but if you're taking responsibility as an auditor to prepare financial statements, how is it possible? It's impossible to do it. And again, I will talk about some of the solvency ratios, which are very important. We will look at some of these aspects. But critically, when you look at it, critically, when somebody looks at any of the financial statements, take for instance, the financial statements that has got, and I've given red and amber. I will share this presentation after this webcast. If you look at predominantly, we always used to do a classification of trade receivables or sundry debtors greater than 6 months, less than 6 months. We used to classify between unsecured, secured, and provision for doubtful, right? Now, if you look at now, you have to classify this trade receivables between disputed, undisputed, good and doubtful. That means from secured, unsecured, and doubtful, you're moving to first classification as undisputed dues, disputed dues, and good and doubtful. So now let's take the classification of disputed dues. Under disputed dues, you need to classify. When you say undisputed, that means there's no dispute on the price, there's no dispute on the quantity, there's no dispute on the selling terms, everything has been received in good condition. Now you need to classify these undisputed dues under considered good, which has significant increase in credit risk and credit impaired. That means even if I say undisputed, I have to classify now between considered good, considered where there is a significant increase in credit risk. Final one is where the credit is impaired. Means what? When you say the credit is impaired, it means you are not going to get that money. So therefore, you sent out a confirmations, you did anything, the party has closed his shutters and is gone away. So you're not going to get it. It's more like a bad debt. But let's take this instance of where significant increase in credit risk. Now, consider good and good. We have no problem. You say we sent confirmation, they've sent confirmation, these guys are paying money. So therefore, there is not a problem. But when you say credit risk has been impaired, that means you need to now understand what is the type of business this whole industry or the entity or the client is in. Understand the client and then categorize. You say, okay, fine, you're in tobacco. Okay, in tobacco, let's say you're selling to an agent, you're buying from someone and you're selling to somebody. So let's say you're selling to the tobacco company, the ITC, because Guntur is very close by. You buy from the growers and you make it right and then sell it across. Now, some companies are good. Let's say ITC is a undisputed, you might say considered good. But you may also sell to somebody who is non-ITC or some other industry. There you need to identify whether the supplies are regular. You need to identify whether the payments are regular. If the payments are not regular, but it's like, let's say if you got business of, let's say, 10 crores with that party, you have been receiving 50 lakhs, 20 lakhs, 25 lakhs over a period of 6 months or something, whereas your credit period is 90 days. Now the question then comes up is the credit impaired? Because your average due date is about 90 days, but he is not paying me 6 months. Even after 6 months, I'm not getting more than 50%. So the question is, how do you understand and classify it as credit impaired? That means, wait, there is a significant increase in credit. Means you keep on motivating, you keep on making that person come time and again. The question then comes up, if this is considered good, but credit risk is impaired, then you need to make a provision. First do a classification. Next is where it's completely impaired. So you don't have increase in credit risk, but it's completely impaired. Now you classified this. Now on this, you need to make a provision. On the doubtful, you may have to provide 100%. On some other things, you may need to provide something what is called as using the expected credit loss method. How will you do that expected credit loss method? You look at the expected credit loss method using the ability of the customer or the client to make the payment. To that extent, you need to be very, very careful. So you can't just say, I will go to the client, prepare debtors classification and do it. No. Understand business, understand customer, understand terms, understand realizations, and then come and do the classifications. This is on undisputed. Okay, this is a very simple thing, undisputed. No legal cases, no questions, no disputes and all of that between prices, contract. But you also have to classify the receivables under disputed. Even under disputed, you need to classify between considered good, again, which has got significant increase in credit risk, and again, where credit is impaired. That means earlier secured, unsecured, good, and all that you did. Now, break down between undisputed and disputed. Again, classify between considered good, which has got significant increase in credit risk, and where credit is impaired. Now, what period you give? You have to classify between less than 6 months, 6 months to 1 year, 1 to 2, 2 to 3, greater than 3. Simple example of a trade receivable. If you have to go through this mode and do an audit, is your work increased or not? The answer is yes. Should the client pay you for the increased fees or not, for the increased work? Yes. That is what you need to be very careful today, because today you are not paid for what you do the work. And if you take the role of a management, that's much more a great difficulty. So the aging for trade receivables is just one tip of the iceberg, where classification between disputed and undisputed, considered good, then classify between where credit is impaired or significant increase in credit risk, and then where credit is impaired, similarly for disputed, and classify between 6 months, 6 to 1, 1 to 2, 2 to 3, 3 and above. Simple, not an issue. Then you have this trade payables. So far for receivables, we had this. For trade payables, we did not have. Now, trade payables also have to be classified similar way. Classify it between bucket wise, less than 1 year, 1 to 2 years, 2 to 3 years, and greater than 3 years. Why is this less than 1 year is important? Because you would have a credit period, let's say 120 days, and it has not been paid. And let's say if it is between 1 and 2 years and these trade payables are not paid, is it in the nature of a loan classified under section 73 to 77? You need to be very, very careful here, because when you do the categorization, because there is another element that has been brought in the trade payables, is classified between MSME and non-MSME. Now today, if you see the definition of MSME, the micro, small, and medium. The micro was has been increased effective 1st of July 2020. The investment has been increased to 1 crore and the turnover to 5 crores. Then the small is 10 crores investment, turnover of 50 crores, and for medium 50 crores and 250 crores. In other words, what you're saying? In other words, you're saying any companies up to 250 crores, you need to find out this original information. Is it possible for you to find out? If you're doing the audit, if you don't understand the business, this is something which you need to be very, very careful. So when you classify aging, you need to have bucketing wise information. Similarly, aging for capital work in progress and intangibles under development. Now, capital and work in progress, typically you will have year on, keep on putting on the capital work in progress because there is some COVID is one issue, non-COVID is another issue, company is not able to raise finance, company moves all this expenditure. If you have to show more profits, company moves all the expenditure to capital work in, some of the expenditure to capital work in progress. You create something called intangibles, like pharma companies or IT companies create intangibles. Here also, you have to go project wise. Project 1, project 2, classify between less than 1 year, 1 to 2 years, 2 to 3 years, greater than 3 years. Not only this, you should also identify between which are projects under progress, projects which are temporarily suspended. So you have, so far you used to only give capital work in progress and give one amount or give a disclosure in the notes to accounts. Today you need to classify this project work in progress, project temporarily suspended. Again, classify it between project wise. In other words, what it says that where the original plan for cost of project was X rupees, but that project plan has gone up, the cost has gone up. You have to provide that details. So, and what is the time that is going to be taken to complete this? Just imagine, in other words, you cannot keep on carrying anything in your balance sheet under capital work in progress or intangibles assets under development. This is a very critical aspect of it, which has to be examined by every professional. And I'm telling you why this is important is because you need to know when this project was commissioned, why this was not completed. So you need to have an entire completion schedule. And you cannot say that the company has got and you against leave all this. Against this, there is something called a loan, which is taken to fund this capital asset. And we keep on issuing certificate called, yes, sir, this is for the purpose for which it is taken. Actually, there is no project that is happening. And that's a very important aspect of it, which needs to be addressed. Next, title deeds of immovable properties not held in the name of the company. Now, we as professionals, many companies, what they do, they want to set up a company. The person says, sir, I don't have money. I have got only about 50,000, 1 lakh I have got. Because private limited company, I'm going to have 1 lakh. Now, the question then comes up, but sir, I want to take a loan from this company. So you as an advisor or somebody as an advisor goes and says, sir, me daggara intlo land undi kada, building undi kada. Why don't you convert that, use that as your home office? And then you take this as a part of your assets. Oh, very brilliant idea. Kani sir, adi illu kani adi illu dan perlo undi. No problem. We will say cash assets capitalized other than cash, and I bring it as a part of debit assets and credit share capital. Now, the other part which is not disclosed is out of borrowed funds, which is not disclosed. Let's say if it is mortgage, those are not disclosed. Then what you do is, sir, meeru panchayandi sir, utti transfer chestene kada sir idi, whether we had been mortgage or not. Mana transfer cheyadame avasaram ledhu sir. We will just bring it and show that as an asset pending registration. And many of the banks have actually suffered. Whenever the company used to go for borrowed funds, or whenever they used to go for what is called as refinancing because the company is not doing well or the debt has to be refinanced or rescheduled, when they do an inspection, they find, and the bankers have found, that the assets are not in the name of the company itself. Now, fundamentally, if it is not in the name of the company, how did you show it as share capital? Or did you disclose saying that it is pending registrations? How long you will it's pending for registrations? So this is a very important aspect. So somebody raised, sir, what happens, sir, if Tata Motors have got, Tatas have got, should they have report all of the assets? The answer is no. If the title deeds you verified is in the name of the company, other than those, you can give as an exception. You don't have to give the entire fixed asset register relating to immovable property. But this is a significant impact which you need to look at it very, very carefully. Because you may also have something called Benami transaction, which we'll talk about later. But this is something which is very, very critical. Next. Disclosure whether fair value of property, plant and equipment, intangible assets is based on valuation by registered valuer as defined per the valuation rules. So typically what happens, many companies say, sir, nenu ee land ikkada konnan sir, akkada sir ippudu land depreciate ayipindi sir. Intamundu Amravati konnan sir, Amravati lo padipoyindi kani sir ippudu itu side konnan sir, kani super ga perigipoyindi. Sir, ippudu manam loan తీసుకోవాలంటే ఏం చేద్దాం? So we give an advice, why don't you do a revaluation? So you appoint a registered valuer, the asset is increased in the books, you increase it through revaluation surplus. Now what the Schedule 3 requires is, where there are any changes to the revaluation, due to revaluation, in relation to property, plant, equipment and intangibles, by over than 10%, suppose you add value of 10 crores, you value to 12 crores, over than 10%, so it over 11 crores. Then you have to give the entire details, who carried out the valuation, what is his name, what was the amount, and how much is it increased. That means anything and everything you do, you need to bring your drop. Next, shareholding of promoters in share capital note. So far in Schedule 3 in financial statements, we used to only disclose relating to 5% and above shareholding. If there are any shareholding over and above 5%, we used to share that. Now it says the entire shareholding has to be provided. Why? So here was a case where the shareholding was there more than 5%. Slowly, the shareholding was given to, because it goes in the way it happens in a promoter company, you give it to son-in-law, daughter-in-law, something. So they went on distributing it without disclosing to whom it related, or they started gifting it. Therefore, what used to happen when bank used to go for security, and when bank used to go and claim for those shares, they said, sir, if the gift chases sir, register ayipindi. Nothing is brought into this. They still fall under promoters category, but nothing is brought into the attention of any of the person from which the loan was taken. That is the reason why now the entire shareholding of the promoters has to be provided. Even if it is 0.01%, you have to provide. Next, loans or advances to promoters, key managerial persons or related parties in the nature of loans, either payable on demand or having no terms of payment, repayment, amount and proportion. Suppose you've got 10 parties, you've given a loan of 50 crores and that has been broken down to various 10 parties. Each party, what is the percentage? That is called proportion. Now, you have to identify to who is the promoter, who is the KMP, who is the related party. Now, who is this related party? Related parties is not what is defined under the Companies Act section 177 or 188, but those defined under the Indian accounting standard AS 18 or Ind AS 24. You have to look at that aspect. Now, when you have a related party disclosure relating to it, then you need to give breakdown of what loans you've given, whether so some companies what is, sir, double chesindi sir, malli repay chesindi, then dan tarvata malli you will give the loan. No, even the rollovers have to be provided. That is the extent of what classification is needed for loans or advances to promoters, KMPs, related parties in the nature of loan, either repayable on demand or having no terms of payment, and classify between period of repayment, amount, as well as the proportion in respect to the total. Next, current maturities of long-term borrowings to be disclosed under short-term borrowings. All the while, we were showing this under current other financial liabilities, because these are current liabilities relating to the long-term borrowings. Now, the reclassification that is required is that if it is a current maturity of long-term, show it as separate line item as short-term borrowings. Don't classify it under other liabilities. What has used to happen? When somebody used to look at the balance sheet, they never used to identify what is the repayment of the current period. It is get hidden in other financial liabilities. So the banker said should shown as short-term borrowings, even though the payment is next to within 1 year. Show it as short-term borrowings. Next, security deposits should be disclosed under other financial assets. This is already there for Ind AS, but this is basically for the non-Ind AS, where you have to show it under other financial assets. Next, lease liabilities to be disclosed between current and non-current financial liabilities. This is again done for Ind AS, but for the accounting standards under lease liabilities, that means anything that is going to be paid using the standard of lease accounting. If you have set up something on lease, right, the IFRS, the Ind AS 116, or any other lease liabilities you have set up, then you need to make sure that you classify between current and non-current. So on the face of balance sheet, that means it doesn't get into your notes, but it comes on in schedules, but it comes on the face of the balance sheet. 12. Undisclosed income for transaction not recorded in the books of account, but surrendered in tax assessment. It has an impact on the P&L account. It's a reporting responsibility even on the CAR. Now let's look at this. All these years, you have been issuing a financial statement which says true and fair view. We have carried out the audit of XYZ based on the examination of such books and records, and based upon the standards which are used for the purpose for which an opinion is issued, based upon the ethical principles prescribed by the ICAI, and based upon our examinations, the financial statements, balance sheet, cash, profit and loss, cash flow account, and notes thereon give a true and fair view. Now, here is one company. Sir, we went to buy piece. We have disclosed this is not recorded in the books. Does this tantamount to reopening of books? Does this tantamount to fraudulent transactions not recorded? What is the role of an auditor? It raises a question where somebody says, you have examined, because you give always based on the examination of books and records, but suddenly you went to the income tax department and say, I surrendered my income on which you're paying tax because you want to buy piece. This will be an issue which you need to deal with, whether it's a fraud, whether it tantamounts to a restatement. All of these becomes a big issue. Similarly, details of corporate social responsibility, including amount spent or shortfall or previous year's shortfall. Now, corporate social responsibility started its journey as only a disclosure in the P&L account, in the notes to account. Then the disclosure got enhanced between what was provision made to what was amount utilized. Now it has come to a situation wherein if you have set up a corporate social responsibility, first you have to go, and if it is to a direct fund, it's 6 months, you should deposit in a bank. If it is not related to direct fund, not project, you have to deposit within 1 month. So now they've, similar like a dividend, they started doing this. Now let's say you've given it to some social foundation or organization. You need to now find the end use certificate relating to it. So there's so many changes that have come through. If you have to refer to all the frequently asked questions, the frequently asked questions under the details of corporate social responsibility will answer a lot of this. So this is a big significant. Somebody might say, sir, my COVID వచ్చిnd, sir, ఎంప్లాయీస్ వాళ్ళందరికీ మీ ఇన్సూరెన్స్ తీసుకున్నాను సార్, మా ఇన్సూరెన్స్ ఇక్కడ మెడికల్ ఎక్స్పెన్స్ అయింది సార్, షుడ్ ఐ నౌ టేక్ దిస్ సిఎస్ఆర్? Any amount spent on employees, relatives, friends, promoters, shareholders, all of that will not come under corporate social responsibility. That is because of contractual obligation. The company has got contractual obligation to enter into this, and therefore it gets classified under CSR. So this is something that will not be considered under CSR because it is not related to an activity defined under Schedule 7 purposes. Next, disclosure for equity to be given for prior period also. Now, this is a significant shift. Under the old accounting standards, if the company is not in it, old accounting standard, US accounting standard AS5, which deals with prior period errors. Under the Ind AS, you cannot have a prior period error. Under Ind AS, you need to go now with this revised Schedule 3. If there are any errors which are material, if there are any errors that are material, that should be classified as restated. In other words, whatever errors you have identified, let's say 2 years ago, your balance sheet will now be 2 years ago, previous year, current year, and 3 balance sheets have to be presented. And the changes have to be presented in the statement of changes in equity. And that is a significant change that is coming through, especially for those companies which are under Ind AS. Next, separate column to be given for defined benefit plans and financial liabilities under reserves and surplus. This is only a modification. Next, details of quarterly returns and summary of reconciliation if the borrowing is against security of current assets. So in other words, what you have to do, whatever information that you have disclosed to a bank as stock statement, which include inventory, which include receivables, which include payables, all of that, it is important that you need to look at each of this with the books and records. Many private companies do not close books and records on a quarterly basis. How are you going to derive this information? So therefore, you should go back to your client and say, hey, listen, all of these information needs to be captured, and therefore, please close your books of accounts as of every quarter. So therefore, I can have at least information that is provided as per books. If it is not as per books, provide the reconciliation as the nature why there is a difference. That is what you need to do it. And this has to be done quarterly. So some client came back and said, sir, what happens if I don't do closely monthly, month 1, month 2, there's a difference, but quarter 3, the quarter is fine. I said, that's fine. Because here the reporting requirement is only about details of quarterly returns and summary of reconciliation if borrowings is against security of assets. Now, where do you have to give? You have to give both under notes, under additional regulatory information, as well as in CARO. Therefore, this becomes the important aspect of it, which becomes the responsibility of the management, as well as the responsibility of the auditor. Next, details of utilization of borrowed funds and share premium account. Now look at this aspect of it. You have raised funds, money came. You have borrowed funds, money came. Now, when the money is advanced to intermediaries or receives from a funding party, you have to see the end use of money. You see, these were all there only for listed companies. It was not there for unlisted companies, private companies, which are fallen. But with this introduction, every information of loans that have been taken, you need to verify it and come back and validate it whether the money funds have been utilized. That means you have to do 100% scrutiny of all these accounts, bank statements, and then come back and then say these monies have been used for the purposes for which it is taken. Somebody may say, sir, anyway 2 months tarvata maaku double vachestadi sir, my utilize chesukondi meer report cheyakandi. That's typical of any of the clients come to you. But the issue then comes up is if the money was used for some other purposes, other than for what it was borrowed, even let it be for a short period, you need to still classify it as a diversion of funds. And that is where you need to do the talking. Next, details of Benami properties held. Details of Benami property held is what? Now, to escape income tax, suppose you are a politician, or you're working in an electricity department, or you're working in a government regulatory department, any department, or you are someone where say, I want to distribute funds. So you start distributing to those pure servant, drivers, somebody, because, or you want to have this land ceiling act not to be included, so therefore you bring all of this. The Benamis Act of 1998, you need to look at from that perspective from this. But if you have any details of Benami property held, right? In other words, what is a Benami? Even though the property is in the name of the other person, the benefits are enjoyed by the person who actually belongs. So let's say the driver owns that property, let's say commercial property, but all rents goes to whom? To the owner. That is called, driver becomes the Benami for the owner. So to that extent, you need to see if there are any difference. So you have to give disclosure in the notes under additional regulatory information, as well as give it under COR. It's a very important aspect of it. Somebody may say, sir, how do I know? I don't even know. That is where your declaration, your verification of fixed assets, whether the title deeds are in the name of the company or any other person, that is where you need to start looking at. Next, details of default if company is declared willful defaulter by a bank or financial institution. So you have a consortium bank, you send confirmation of balances. You have to necessarily send confirmation of balances to all the banks in which this company has got arrangement, a debt arrangement, and say whether any of those consortium bankers have declared this bank as willful defaulters. Willful defaulters, in other words, means one who has not complied with the terms and conditions of the contractual sheets in relation to payment of interest and principal or creating security. That is the extent of classifying it. So if it is a willful defaulter, what happens? The moment it becomes a willful defaulter, the entire portfolio of long-term liabilities will become your current liabilities. Next, delay in registration of charges or satisfaction beyond the statutory period of 60 days. Again, this is a disclosure which should come in the notes to account. Next, details of the fund, where the funds are used if utilization of borrowed funds is not for specific purposes. You got general funds, you got some funds, but you've utilized for other than any purposes. So the utilization has to be checked. Just look at it. That means the entire thing, you're bringing that information and putting in the notes to accounts. Entire bank statement, you say total loans borrowed 200 crores, of which total funds deployed in plant and machinery 50 crores. Total funds deployed in working capital, that means management, is 170 crores. Total funds used in purchase of fixed assets is let's say 20 crores. Just look at all of these, and other purposes 10 crores. That means you have to give the nature extent as to what these funds have been utilized. It is only possible when you start going and validating the bank statement by yourself. And that is the extent what has to be done. Details of cryptocurrency or virtual currency, so far in India, it is not prevalent, but if you've got companies which deals abroad, they may possibly have. Details of ratios along with explanations of computational details. What does it mean, ratios? The financial ratios. So you may have to use a profit earning ratio, debt equity ratio, a current ratio, liquidity ratio, interest service coverage ratio, fixed asset turnover ratio, inventory turnover ratio, creditors turnover ratio. All these ratios have to be provided. And if there is a difference of more than 25% between the current year and the previous year, you need to still provide that information of the classification as to what is the reasons for such. Next, disclosure of compliance with approved scheme of arrangements and deviations thereof. In other words, it means if you've got any companies which to be merged, those companies' information has to be complied. If there are anything, it says you need to comply with Indian accounting standards, you need to comply with this, you need to comply with ABC. All of that information should be provided. 25th. Compliance with the number of layers of companies as per Act. Under the sections 287, no company can have more than 2 investment layer companies above it, not more than 2. If you've got more than 2 investment layer companies, then you need to provide that information. Whether it becomes a non-compliance in the Act, then you need to address that Act. Finally, is relationship with struck-off companies. The struck-off companies' informations are available under the MCA website. If this company has transaction with them in respect of receivables, in terms of payables, in terms of fixed assets, in terms of anything, they have that information available there. And if that information is not is taken and provided, you have to give this. So it could impact your receivables, it could impact your payables, it could impact everything. If it is the nature of those struck off companies, because there are more than 2 lakh companies that got struck off, and whether that got impacted, whether that has an impact is what one needs to look at. So this is something which is very important changes that have come through it. I will pause here to take any questions you may have in relation to this. If there are any questions, please let me know at this point in time. You can unmute and talk before I go to Karo.
Satyanarayan,
it looks like a portion type, not a ordinary financial. I see that. And these disclosures are far-reaching effects regarding many companies invested in startups. They are invested in properties. They are not filed at all any returns. Now those companies are stuck up and the properties are held up. What is the fate of those companies?
So your question is if there are transactions with those companies which have been struck off, right?
Yes. But
so now you need to identify those therefore what you have to do is there's an MCA website that provides a list of companies which have been struck off.
yes,
So you have to go and download the list of companies and then see if there are any major parties for which payment has not been received or payment has not been made. Then take that companies and compare with those companies. So that information is what becomes our responsibility.
It is very difficult to find out the MSMEs nowadays because whether they are registered or not, we don't know. Well, even though it was not registered in MSC, we have to classify as an MSC company.
No, you're right. You may not necessarily know all of them, but what happens is now the rule says, what is the rule? The rule says that there are changes to MSME. The company should send out, because the company responsible today is what? Every half yearly, they have to file this return of transactions with MSME. So one comes in October, the other comes in April. So when they file that, they have to update this and send it across. And in case if they have not filed it, you should ask why they have not filed it. So this is a very important aspect of it that needs to be addressed.
Regarding many private companies are very small companies, it is only family concerns. They are not bothering about all these things. They know this is a company when they are coming to our high court.
I fully agree with you, sir. Exactly what it is. What you're saying is absolutely right. My whole address is because you are taking the responsibility of what are you taking the responsibility? You're taking the responsibility of preparing the accounts, of maintaining their books and records, and then submitting it. That is because they say, sir, maake ardham kaadu sir, meeke anni telusu sir, mere chuskondi. Ma daggara anta staff leru. Because that is మీరు ఏది ఇచ్చినా అదే సార్ మేము ఇంతే సార్ మాకంతే మాకేం తెలియదు. So the fundamental point, which is very critical here is, when you're taking the role and you're submitting your report, financial statements, you're owning that responsibility.
But why don't we discourage this corporate sector? Because many companies are opening because of their style wise, their name wise, that's all. They are not doing anything.
Sir,
But they don't know the intricacy of the opening a company, completing a company. That's a problem now.
so andike ka sir, Nefra has come up with up to 5 crores, no audit is required and vachar kada. But the whole objective Nefra is coming is, anyway you're not adding any value, what is there to for you guys to do the audit?
Yes, yes.
So the whole consultation paper, see, my point is different. My point is on the consultation is because they are basically saying your fees is low. You just shift this fees to 1 lakh, 5 lakhs, yeah. Automatically the numbers that I talked, that 5 lakh companies automatically goes up. The bottom case becomes 0.
But government also can restrict the corporate sector. We don't have any turnover up to this, or we don't have capital up to this. Don't go come for a private company corporate sector. Why don't you do that regulation? Government itself.
Sir, government only knows, see, the government thinks that auditor and company are same. Unfortunate, but that's reality. 2, they don't see any value for an auditor signature. You may take pride that, auditor signature, Prime Minister of India himself said, no one is so powerful other than your signature. You take pride, you keep bashing yourself, patting yourself, saying that, oh, great. But this document that you file with your signature has got no value. When it has got value, it's get value because when something goes wrong, then they say, what did you do? You only sign, na? You tell me what did you do? Then only the value comes through. So therefore, what is important for all of us? Go back to the traditional account auditing of where call for information, get all the documents, ask the questions and do it. Otherwise, another 2 years, this will go away. Mandatory audit will go away. Once mandatory audit goes away, once bank audits goes away, what is the role of chartered accountants then?
Just filing the ITs.
Bookkeeping, they will all go to industry. The only role then they have is industry.
Yes, sir. Yes, sir. They have to go for a job.
So this is the extent where you need to be very careful. But I'm saying be mindful, because this is a great challenge for all of us. It's not a challenge because just for one location or one place, but it's a big challenge for all of us. So, but we need to be mindful that we need to ask the right questions to the people, right? Put our case and get that information when you do it. Any other questions from any other participant?
No, sir.
All right. If there are no questions, then let me take you to the most critical aspect of it is the auditor's report order 2020. Now, one of the key changes that has been brought in, they said the auditor is not doing enough, which is rightly so. So let me ask one question that we all deal. The first clause under the CARO relates to fixed assets. So what do we do with the fixed assets? With the fixed asset, we say the company is in the process of updating the fixed asset records. The company has a process of carrying out a physical verification of fixed assets in a phased manner, based on which, as and when the physical verification is carried out and the books are updated, any discrepancies will be adjusted. That's all it's told. That's how it comes. But 1956 Act also had the same clause. 2012, 2013 has also clause, 2016 also has got, 2006 also had the same clause. What did we change? English is the same. There's nothing which got changed. So now look at what are the changes that they've brought in. So now what has really happened is they moved away from based on information and explanation. They brought in what is called as evidences based on examination. So when you are based on examination, there are a lot of changes that have been brought in because there were representations from industry, there were representation from bankers, ROCs, the regional directors, All of that they wanted to bring in. So there are so many changes that have been brought in. In the interim, there is also this fraud that happened. Now, today we are talking about fraud. In businesses, when you're doing your audit over virtually, right? Take this case. Today we are conducting this seminar. Let's say there are about 150 people registered. Now, this is election time. Will you give credit for 150 people, or you'll give credit for only 18 people, excluding the... So you have to think through it. So the question then really happens is, this is where non-compliances started coming. This is where we never took it serious. Caro was never taken as a serious. Now, this is going to impact all of us. 2020 versus 2016 will have a larger impact on the auditors than what it was. So just when you had this virtual audit in 2020, a lot of this information we have done without even visiting a client. Sir, my inti pampichesindi sir, main chusuni cheptamani. That is the extent of what we need to be very, very careful. Now, one of the important changes that came up in the auditor's report in SA 700 was inclusion of paragraph relating to management responsibility, saying that the financial statements have been prepared on a going concern basis. And we need to look at the going concern basis. Now, I'll give you a simple example. The financial ratios have to be given. What are these financial ratios? These financial ratios are nothing but the solvency ratios. These are predominantly nothing but the solvency ratio. Now, if your solvency ratio, what is the test for a solvency ratio? Your current ratio, your liquid ratios, your gross profit ratios, your net profit ratios, your debtor turnover ratios, your debt equity ratios, your interest service coverage ratios. These are called your solvency ratios. Now, if the solvency ratios are adverse, then fundamentally you have to go and qualify the auditor's report saying that the financial statements are not prepared on a going concern basis. That is the biggest change that will come through in this aspect of it. We are not realizing this impact that is coming through, which is very, very critical. The impact which is coming through is that if there are any changes, adversity in the ratios, financial ratios, these financial ratios will run into an issue of going concern if they're adverse. Second, bankers went back and said, our fraud is because the auditors are not reporting us on the diversion of funds. Because auditors are giving a true and fair view, but the auditors are not giving an opinion on true and correct. I want to know all the loans that have been taken. Working capital loan, term loans, equipment finance loans, any loan, packing credit loan, export credit guarantee loan, anything that has been taken, whether that funds that have been taken has been utilized for the purposes. So now they've introduced diversion of funds. That means you have to go to the entire spectrum of loans taken and verify that whether it has been given or not. Just look at the effort that you need to put. We also have to support on the internal audit support. That means whether the internal audit system is adequate or not. That is the extent you need to do it. Of the 21 clauses, clause 21 is applicable to consolidated financial statements, where only if there are adverse findings, you need to bring that information. It is commencing from April 1st because it got aligned with the Schedule 3 reporting. And this is applicable for the entire reporting of components. Now, the biggest thing which we need to do is opinion is expressed based on examination based. That means you have to examine whether title dates are in the name of the company, of the immovable property in the name of the company, title deeds, you have to give. Whether all the issues that have been identified by the internal auditor, whether it's commensurate to the size and nature of business, whether his observation on this has got an adverse impact on the working of the company, and how the auditor has done. Information sought. Whether the company that has borrowed funds has used the funds for the purpose for which it is taken. Examination. Look at all of these. It's a combination. This, even though there are 21 clauses, including subclauses of 26, there are 47 reporting points that has to be given. 47 reporting points with all this classification details. Should it not be greater than your audit fees? The answer is yes. And that is where seriousness, not only this, suppose anything is not reconciled, suppose something there is a difference, does it impact my internal financial control reporting also? You need to examine this. So what should you do? Submit a questionnaire, prepare a detailed checklist of what is needed, make additional inquiries, get the replies in writing, look at the discussion, you verify all of these once the client prepares it. You have to do all of this. So the first aspect of it is maintenance of proper records, property management, and intangibles both. Earlier it was only fixed assets. Now it is property, plant, equipment, and intangible assets. And in intangible assets, you need to be very, very careful relating to this, because intangibles could be your, drug master files, right, or an ANDA, but it could also be some software licenses if the company is in the process of software license, or it could be in the nature of trademarks or copyrights. Those are in the nature of intangibles. So this is something you need to be very, very careful and clear about it. And this is very, very critical. But the bigger problem comes to us. We cannot be repeating the same question and answer of saying the company is in the process of updating fixed asset register. Arey Baba, if the company is in the process of updating fixed asset register, how did you report on internal financial control that the control? What is an internal financial control? That means right from the time to start initiating a transaction till you conclude the transaction, till you make the payment, till you record all depreciation, that is internal control. If that register itself is in the process of updation, how did you then issue a clean report on IFC? This is a very important aspect that needs to be looked at. The second aspect I talked about, the title deeds. I will not repeat it for the purpose of this, but title deeds are very important. You have to examine it. If it is with the banks, mortgage with the banks, get a certificate from the banks. If it is available with the company, physically verify. If it is elsewhere, get that verified. You have to give the name, particulars, amount, and the nature of the situation. Revaluation already touched upon, threshold is 10%. Proceeding related to Benami property I've already touched upon. That is something we shouldn't give. Next is very critical. Physical verification of inventory, including coverage and procedure related discrepancies, threshold is 10%. That means if you have inventory called raw material, work in progress, finished goods, material in transit, stores and spares, consumables, all of these are there. If you carry out physical verification, there should be process and procedure that you need to first check. And any physical verification in excess of 10%, there is no material amount, in excess of 10%, line by line item, you need to provide this information. And this becomes a very critical aspect of it. If the physical verification of inventory is not done regularly, then you have an issue, fundamental issue on internal controls. You have a fundamental issue. How did you validate and value the inventory on the balance sheet? And how did you give an opinion on the true and fairness? Next, working capital in excess of 5 crores in aggregate, submission of quarterly returns and its agreement with books. In excess of 5 crores in aggregate means you have, suppose if I've got a borrowing of, let's say, 6 crores. I've got working capital, I've got packing credit, I've got various things. But I've only drawn 1 crore. 5 crores I've not drawn. Even that also has to be given. It only says limits. It does not say utilized. Working capital limits, that means any limits that are in excess of 5 crores, you have to provide this information. Next, investments, guarantees, security, loans and advances in the nature of loans to any party, security, secured, unsecured, disclosure separately for subsidiaries, joint ventures, associates and others. What should you give? Whether they are prejudicial to the interest of the company, whether such companies are regular in repayment of dues, or whether the overdues are more than 90 days, all of these you need to look at it. That means the entire amount that you've given over a period of time, go back and check terms of investments, guarantees, securities, loans and advances, the nature, not prejudicial. You cannot have a rollover because it says where the principal business is not to give loans, whether fresh loans granted to settle the existing loans given to the same parties amount and proportion should also be provided. That means the entire loans and advances, you have to go get down to the granular details and get that information. Next, loans or advances in the nature of loans, either repayable on demand or having no terms of period of repayment, amount, proportion, loans to promoters, related party. Related parties again defined under Ind AS as well as under the accounting standards, apart from sections 177 and 188 of Companies Act. Just imagine, just the loans, no longer you can go back and say, these are good and recoverable. You have to go and give the complete details. Next, loans, investments, guarantees, securities given where the provisions of section 185 and 186 have been complied with. That means given to loans to directors, loan to companies, all of these you need to look at it and have that addressed. Acceptance of deposits, again the same classification. Maintenance of cost accounts, absolute no problem. Depositing of undisputed statutory dues and disclosure of statutory dues under dispute remain the same. There is no change. But what is very important for all of us is recording of unrecorded income where surrendered or disclosed in tax payments. That's a very, very critical aspect which needs to be addressed. Next, defaults in repayment of loans or other borrowings or interest to any lender. Any lender. Could be NBFCs, could be financial institutions, could be banks, could be anybody. If there is a terms of payments and the terms of payments have not been complied, you need to give the default. What is a default? If it is a due date and you have not paid within the due date, that becomes a default. You don't have to wait for the entire year. So any number of defaults that has been done, you have to provide for it. Next, whether term loans applied for the purpose for which obtained, whether not amount so diverted, again, go back to your bank statements, do a deep dive, do scrutiny of the bank statements, and then come back and say, this is what you need to identify. Now, this is a very important aspect. Why I'm saying this is very important is no longer you can do sampling. No longer you can do bank reconciliation. You have to go take every money received, every money applied, every payment made, and see whether short term and long term. How do you identify? You can identify through even operations. Companies not made profits. How can you then say the short term did not be used for long term purposes? Because the long term purpose source is either you borrow from banks or you bring your owner's capital. Other than this, there is no long term. So the company is not making money, the company is capitalizing it, company is utilizing the working capital loan for this purpose. You have to say that's a diversion. That comes under the category of diversion. Because the funds have not been used or the funds have been used for long-term purposes, nature and amount. It's a very critical aspect of it. Whether company is declared willful defaulter by any bank or financial institution or other lender. So defaults is one, willful default is another, term loans taken and applied is another, if not what diverted. Or funds raised on short-term purpose for long-term purpose. The entire ambit of entire banks, whatever relates to banks. If you are auditing that company, if you are preparing any financial statements, get that information up and running. It will be a big challenge if it is not done. Next, whether company has taken loans, any funds from any entity or person on account of to meet the obligation of its subsidiaries, associates and joint ventures. That means you have taken loan from your parent company. Parent company went to the bank, it took loan. And when they've taken loan, now the bigger issue that came up is they wanted to fund the subsidy. In fact, if you see many of the diversion that happens, it happens only through what is called as subsidiaries related joint associates and joint ventures. Now, if such thing happens, You need to now identify this. These funds have been taken at the parent and then utilized for that. And that will have a significant impact. Same is the case where the company raised loans on pledge of securities. You got shares allotted to you and you went and pledged it with somebody else. Subsidiary joint when associates provide details and report. Look at the extent of verification one has to do. Application of money is raised, including debt. In other words, we are not doing audit. We are doing an investigation. We are saying end use report. We are saying, please give me all of this. I'll make a report and give you. It's a long form audit report sort of a thing. Compliance with section 42 and 62 in relation to preferential allotment or private placement of shares. Again, there is nothing changed. Next, fraud by on the company, nature and amount involved. And this is where the whistleblower mechanism is important. You tell me any company, how do you identify fraud? I have not, see, there are companies, more than 4,000 companies where many of the auditors have resigned and say because of fraud, but no action taken. But suppose you don't report on any fraud, you are acted upon by the MCA, by NEFRA. And this is something which is very, very good. Whether any report filed under section 143.12, whether auditor has considered whistleblower complaints. Where is whistleblower complaints? Promoter drives, sir, Anni, AM Raleigh, sir, everything is okay. There is absolutely no issues. Next, whether this is again related to NBFC companies, not related to the other companies, the division 1, division 2, relates to net owned funds, maintenance of unencumbered term deposits, again a classification needs to be given. Whether any default in payment of repayment of interest on deposits has to be reported. Again, if you've got any deposits for which payment has to be made, if it is not done, you need to provide it. Compliance with section 177 and 188 of the Companies Act and disclosure of related parties. And this is where I said related parties is not only under Companies Act, but also you need to look at, because the definition is any other party. Any other party is not defined under Companies Act section 171. It does not define. It only talks about related party relationship and transactions. If you have to go back to all of this, you have to go back to the accounting standard and then look at it. Internal audit commensurate and with the size and nature of business, whether the internal audit reports have been considered by the auditors. And this is where it is very, very important that every internal audit report, you need to look at it and see whether it's got reported or not. Non-cash transaction with directors or persons connected with the firm. If there are any transfer of fixed assets, transfer of inventory, transfer of anything, you need to report. Registration with section 45 IA of the RBI Act. Again, these are all relating to the NBFC companies which need to be identified. Whether there is a core investment company, whether fulfilled criteria of core investment company, whether the group has got more than one core investment company, you need to provide that information. Next, again, these are something which has come back. Whether cash losses incurred in the financial year and preceding amount, all you have to give. Next, auditor taking into consideration issues, objections, concerns raised by the outgoing auditor. Suppose you got appointed for a new audit and you know why you resigned. But the other auditor is responsible to see what are the issues, objection which has been raised. And that becomes a very critical aspect of it, which needs to be reported. Next, on the basis of financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities and other information, management plans, reporting on material uncertainty by the auditor, ability to meet liabilities existing at the balance sheet date when they fall due within 1 year, nothing but whether your current assets are greater than your current liabilities, and that can be paid within 1 year. That is what is called as solvency. Whether the company is solvent. If you say if there are anything more than 25%, because any ratios in adverse more than 25%, you have to report. If you have got any adverse related to that, then you need to identify, and if the going concern comes from there, you need to address that going concern issue. Next, transfer of unspent money, as I said, you need within 1 month if it is not identified to the project, within 6 months if it is identified project, all has to be done, and including the end use of money, you need to identify. Qualifications or adverse remarks by auditors by the competent auditor should be included in CARO. You don't have to do it for consolidated, but you have to do it in the if when you're issuing the report under CARO. Now, what are the issues that have an impact? There are internal controls which needs to be reported. For instance, fixed asset ratio not being made. Proprietary is about 10. Red flags is about 10. Performance index is 8. Compliance is 14. We are talking about 47 clauses. And each of these 47 clauses has a significant impact when it comes to it. It is not only your responsibility that you're giving a true and fair view on the financial statements on which an opinion is issued. You're also not only giving an opinion on the internal control of financial reporting, but you're also including what is a concept called true and correct, because you have to validate every documentation. You've got 20 companies, every 20 companies you have to go and verify it and give it. No longer you can cut, paste, and do all of these. So if I do a bird's eye view part of it, and if I make a comparison between what is there, maintenance of property, plant and equipment, title deeds of immovable property, I checked it in Schedule 3. Revaluation is also covered in Schedule 3. Proceeding relating to Benami property related is included in Schedule 3. Working capital information has to be given by the company in Schedule 3. Investment guarantees to be given under this one. Loans or advances, you have to give it under Schedule 3. Now, another issue which will have an impact is in relation to acceptance of deposits, maintenance of records. All of these have to be included in the report of board of directors. If your company is under financial statements, your Ind AS, you need to look at on financials. If there are any change in fair valuations, that has to be given. Recording of unrecorded income has to be given Schedule 3. Whether company is declared as willful default has to be given Schedule 3. Whether term loans applied for purposes obtained is to be given Schedule 3. Applications of monies raised under debt instruments. Just look at it. They brought in all of these to get included under Schedule 3 as well as CARO. That means you have to have most of this information under the financial statement, under notes to accounts, or in the board of directors. It's a very, very critical aspect of it which you need to cover. Frauds, again, anything which is filed is to be disclosed in the director's report. You need to look at it if there are any defaults in payment or repayment of deposits. Section 117 related party transactions, all of these has to be included under the report. On the basis of financial ratios, CSR funds projects, all have to be given. So if you look at all of these, we are talking about almost 47 clauses that needs to be covered. So in substance, when somebody looks at both the Companies Act as well as the CARO, there is a significant change. There is a mindset change that has to come through from all of us. What is important for all of us is it is not about what changes have impacted, but what is important for all of us is how does this impact us and the clients in the manner in which we will be delivering this year's audit. Do we educate our clients? Do we tell our clients this is the mandatory things required? No longer I can be using this basis of saying only for tax audit purposes, I'm going to use this balance sheet. I think please think through this, all this process that changes have come through. Don't take anything serious because today it is not going to bite you, but tomorrow down the line, 2 years, some inspections come through, because today NEFRA is not only coming on the auditors, NEFRA is also coming on the companies for non-compliances. That means NEFRA, similar to what we had FRRB, NEFRA directly issues a report to the companies and they come for their compliances. This is the biggest change. If you close your eyes like a cat, think nobody's observing you, it's a difficult. If you claim yourself that it is a case of what is called as you want to represent what it relates to, you should do it. And I think it is important for all of us as professionals. If you want to go through like an eagle, you claim yourself as an eagle because you can spot anything at a particular height, be that auditor. But if you think that you are not an eagle, but you can only play a management role, don't sign any financial statements. Don't sign any audit reports. You be a part of the management. The risk is not worth it, because once the report comes from NEFRA and a lot of things will impact. Now, see, you had big fours, now you have non-big fours coming. Another 1 year, there will be many such company reports will come through. Then you will know what really happens, because the cost of compliance is very high. And if the fees is not commensurate to the cost of your rendering service, please do not. That's my sincere advice, because I may sound, I may think I'm a sounding board. I can only tell you, but this is something which you need to look at it and see if it is not worth the risk. It's not worth the risk. With this, I hand it over to the chairman. Over to you, sir.
Yeah, thank you very much, sir. I request all the members, please, if you have any questions, please post directly. You can talk to the speaker or you can chat with the chat box. Sir, some of our member asked that can you please send the sample format of Caro?
Give you some checklist regarding the finalization of audit. If you provide checklist and what are the documents you have to take for conducting the audit are also useful for the small companies. Here many are small companies. That's why any useful checklist or what are the documents you have to take for the conduct of audit, please provide that checklist to be useful for the members.
Sir, please unmute, sir.
Oh, sorry. The ICAI has come up with a detailed guidance on Caro with the checklist information. All you have to do is pick it up there and put it. And again, you have to go and look at each of your clients, right? Look at each of your clients and then fine tune to that particular client and do it. Because you can't be using all general checklists. See, today, what is happen? Cut, copy, paste, and use to issue reports, right? You cannot do that. You have to take what is relevant for this company. For instance, there are no deposits. So what's the point? You don't have to do it. And that is the reason why this becomes very, very critical. So if you have to ask me, there is nothing called checklist, sir. Sir, me anubhavam mein, me experiences what should bring you that information. A checklist to the checklist in the world itself, there's no checklist which can give you the perfect answer. The greatest checklist is your mind. It should ask the right questions. Who is the owner? What is it? What are the details? I can say, please provide me the list of the checklist. What is it? Please provide me the details of fixed asset. Please provide me the owners of checklist. Please provide me the situation of asset. Please provide me the detailed schedule of this. Please provide me all this. Prepared by, signed by. That's it. I'll give you. But that is not what I'm looking at. I'm looking at it. What is it? Where is the property? Where is the security? Can I physically verify? Can I look at it? Can I examine? All of this becomes very, very.
So the chat box, the question is this.
Yeah. So the question is, if a private limited company prepares this thing, under the Companies Act, consolidated financial statements is necessary. Under Companies Act, it doesn't make a distinction whether a private company or listed company. If the company is registered under Companies Act, on an annual basis, the company shall prepare a consolidated financial statements. And if it's got subsidiary, it shall prepare a consolidated financial statements. Or an associate or a joint venture, what is the case?
Any other questions? Yeah, with this, I'm calling it a day, sir. Yeah, thank you very much, sir, being with the forming part of this wonderful seminar. Thank you very much to the eminent speaker, Balganesh, sir. And thank you very much for being part with chief guest Galapat Satyanarayana garu to be honoring as a chairperson today on today's seminar. And thank you very much for the senior members who are appearing here. Even though we are having 1100 members, I'm very much, it's very pinching to have only 20 members on this board. I request all the members who are attending here, please ask your, at least your members, article clerks or something like that, to be participate in the programs, upcoming programs also. Thank you very much, sir. Sir, happy Dasara to you, sir.
Thank you, Dasara. Me andarki Dasara Subhakankshalu.
Thank you.
Thank you.